Let's bring in Ed Yardeni of Yardeni Research. It's good to have you here.
Thank you.
Bond market do this?
Absolutely. I think the bond vigilantes got the president's attention, as Eamon just said. The president was watching what was going on in the bond market. I think we were about to have a credit event, and that's a sure way to create a recession. So everything kind of fits together. In the past, it was usually tight monetary policy that caused the credit event that caused the recession. This time around, it was tariff policy that was threatening recession, and the bond market was anticipating a real crisis.
What now?
Well, I think that we still have obviously a tariff issue, and it looks like there's a lot of confusion whether the 10% is negotiable or not. I mean, a 10% tariff, if it's not negotiable, is still about $300 billion. That's still a very big tax increase. It'll probably mostly hit American companies and American consumers, and so that is an issue. But I raised my odds of a stagflation recession scenario to 45%. I was thinking about taking it higher.
Glad you waited.
But I waited. I did think that the financial markets would have an influence on the president. I've been talking not only about the bond vigilantes, but the stock vigilantes. The silly notion that the rich own all the stocks, so it doesn't really matter if the stock market's down. It's ridiculous because there's a lot of people with 401ks. There's a lot of people that are involved in the market, even if it's small shares. It matters a great deal to them. I was hearing a lot of people that I went and got a haircut the other day, and everybody was talking about how much money they just lost last week. So I think that this is a positive development for the economy.
Did we get a bridge too far in terms of some of the damage that's already been done? Mm-hmm. And is that yet to show its face within this market? Certainly earnings remain the greatest unknown that we could talk about.
I think it could have been a lot more damage if it went on a few more weeks, a few more months. But I think the fact that it got nipped in the bud so quickly is important. And I think Brad made a very good point here. So I was really dreading the idea of going into an earnings season and having managements have to say, we don't know what this is going to do to our business. Now they don't have to say that.
Well, they probably will still say that.
Yeah, with regards to China, for example. Yeah, I think the issue with China is clearly not over, and that's a big deal.
Is this enough of a development today that you would be comfortable suggesting that people buy into this?
I never told anybody to sell it. I told everybody it's too late to panic. And I feel pretty comfortable with that. And I thought there would be buying opportunities. But, you have to be a mind reader. You have to read the mind of the president. Because clearly this has all been initiated by the president. Depends on what he's watched on TV. And, he listens to his advisor. At the end of the day, he says, you know what, this is what we're going to do. And it just kind of comes out of the blue, and we all got hit with it.
Well, look, I mean, someone like Jamie Dimon's an influential person.
Yeah, absolutely.
When he's talking about the probability of recession.
Yeah, well, thank you, Jamie Dimon.
But let's be clear. Everybody, and I'm sure you as well, everybody that I've been speaking with, from the highest of hedge fund managers to the highest levels of banking in this town, were worried about what was happening in the bond market.
Absolutely.
And it had a real chance to get out of control.
Yeah. I think that's absolutely correct. We could have had a credit crisis and a credit crunch, and I think this reduces that likelihood. It's not impossible that something bad will still happen, but we're hearing about a lot of small businesses who are really about to get annihilated because they are so dependent on trade, on what they import.
Are you still unnerved at all about the backing up of yields? How much do we need that? Let's just say, you take this issue off the boil, the so-called basis trades and all that stuff that got talked about a lot on our network today. Let's say the unwind there is, if not fully finished, close to it. Do we need yields to come back down by a significant level to make you feel more comfortable?
Well, it would help the mortgage market. It would help the housing industry. But we've been thinking that the bond yield is kind of back to normal where it was before the great financial crisis. We've been thinking the 10-year should, in fact, be trading at 4.5%, plus minus 25 basis points. We did blink and we lowered that a bit to 3.75% to 4.25%. But no, I think the economy is resilient. I think it's proven over the past 3 years its resilience to tightening of monetary policy. I think we're going to be surprised. I think we're going to have a surge in auto sales. as people try to beat the tariffs on autos. As Steve said, we're not out of the woods on the inflationary consequences of tariffs. We're going to have higher auto prices if Trump doesn't change his mind on that.